All right, guys, welcome to Crypto Price Alerting, the home for the average investor. Yes, us, the average investor, everyday Joe Smoes and Jane Does, teach you every aspect of trading in digital currency as well as artificial intelligence technology. Yes, AI. Tonight's lesson, guys, is about stable coins. Exactly what are stable coins? Lego. A stablecoin is a crypto asset that is pegged to another asset, such as fiat currencies or precious metals. That means such as money, currencies, dollars, the yen, the US dollar, the euro, or precious metals, gold, silver. Okay. Stablecoins are designed to maintain a relatively stable price so that users can avoid the volatility and risk common in the crypto markets. Because crypto is so extra volatile, stable coins give you a little assurity because it's stable, a little more stable, right? Because the volatility in crypto is insane. There are three types of stable coins: fiat-backed stable coins, cryptocurrency-backed stable coins, and algorithmic stable coins. Due to their practical use and large market capitalization, regulators are beginning to take a closer look at stablecoins. That a regulator means the centralized system, the government, the big boys, the whatever, the powers that be are starting to take a closer look at stablecoins. They hate our crypto space, but whatever. All right, now, just so you guys know, cryptocurrencies, all of it is not volatile due to stablecoins. Stablecoins are specifically designed to maintain an actual fixed price. In an industry where coins and tokens can crash overnight, there's a massive demand for an actual cryptocurrency that mix both blockchain benefits with the ability to track a more stable asset. If you haven't started using stablecoins yet while you're trading or you're investing, it's worth learning more about them as well as the benefits and drawbacks that they bring. And here tonight on Crypto Price Alerting, we will bring you some of the assets and some of the detriments of stablecoins, some of the benefits and some of the drawbacks. Stablecoins are digital assets that track the value of fiat currencies, monies, or other assets. For example, you can purchase tokens, coins pegged to the dollar or the euro or the yen or even to gold and oil, other assets. A stablecoin allows the holder to lock in their profits and their losses and to transfer value at a stable price on a peer-to-peer blockchain networks, So what stablecoins do, guys, is it brings some stability to the crypto space, whereas you can purchase a stable coin and that pegging to an asset like a fiat currency or gold or oil, that pegging means it locks the price to the price of the currency, of the yen or the euro or the dollar. It locks it in. So you have a lot less volatility than you have in the regular crypto space, especially in the meme coin space where it's just all volatility. Bitcoin and ETH and other altcoins have historically been volatile. While this provides many opportunities for speculation, many opportunities for you to make money, it does have its drawbacks. Volatility makes it challenging and very, very stressful to be invested in cryptocurrencies. See, when you're trying to invest in cryptocurrency, it's really hard to manage like day-to-day payments or to make to really look at it as a daily income because of the amount of volatility. So when you just investing in crypto, meme coins and altcoins, even Bitcoin too, it's more like a weekly, monthly type of investment, because if you're trying to make a day-to-day payment income, you're gonna have to be doing a lot of trading and investing, because you're gonna have to market in some of the losses and then your gains will cover the losses. but then you'll also have to watch the market all the time. You literally have to day trade. So stable coins bring you a little more stability in this. For example, a merchant, meaning a store owner, may take $5 in Bitcoin for a coffee. So you go into a store, a coffee house, and you want to buy some coffee, and the store owner is charging $5 of Bitcoin for that coffee. But then you come back the next day and the store owner changed the price because Bitcoin had lost 50% of its value. So when that happens, it's almost impossible to use your cryptocurrency as like a fiat currency, like a actual dollar currency, because of its volatility. So you could go buy gas one day and the next day, you know what I mean, you might have $10, want $10 of gas, and the next day it'd be like your $10 is wiped from the volatility. So that's why crypto is really hard to use as an actual fiat currency. Before cryptocurrency, investors and traders had no way to lock in a profit or avoid volatility without converting the crypto back into fiat. I mean, not before crypto, but before, in the past, crypto investors had no way to lock in a profit to avoid volatility without converting the crypto back into your cash first, which is a nightmare. It's a headache, especially if you're doing a lot of trading and got a lot of different currencies and you want to trade it in, and then you're getting hit with fees and all that gas fees and stuff. The creation of stable coins provided a simple solution for these actual issues. Today, you can easily get in and out of your crypto volatility using stable coins, like one of the most famous one, True USD stablecoin, TUSD. Creating a coin that tracks another asset's price or value actually requires a pegging mechanism, something to be pegged. There are multiple ways to do this, and most rely on another asset acting as the actual collateral for the first. Some methods have proved more successful than others, but there is still no such thing as a guaranteed peg. So when you tie your crypto to another asset, pegging it, there's no guarantee that it's going to stay pegged or glued, for lack of better words, glued to that asset. Let's talk about fiat-backed stablecoins, means stablecoins backed by actual currency. The USD currency, the euro, the yen, actual dollars, money. A fiat-backed stablecoin keeps a fiat currency, such as the US dollar or the GBP, in its actual reserves. For example, each true USD coin, TUSD, is actually backed by $1 US held as collateral. So it's a 1-to-1 backing. So you have your stable coin, your crypto coin, but it's backed by $1 US. So the fluctuation, because it's backed by the dollar doesn't fluctuate daily, volatile like cryptocurrency. So more than likely, when you go to buy something for $1 with your true USD stablecoin, it'll still be worth $1. Versus if it was just crypto, you go in there, it could be worth 10 cents by the time you go in there. Or you can go in there and it'd be worth $1,000. That's the volatility of the crypto space. Users can then convert their fiat to a stable coin and vice versa at the pegged rate, at the glued rate. So you can convert your dollars to stable coin and your stable coin to dollars at that rate. Now, another stable coin is crypto-backed stable coin. A stable coin backed by actual cryptocurrency. It works in a similar way to fiat-backed stable coins, but instead of using actual dollars or another currency as a reserve, we have cryptocurrencies that are acting as the collateral. As the crypto market is very, very highly volatile, crypto-backed stablecoins usually over-collateralize the reserves as a measure against price swings. What that means is when you purchase a crypto-backed stablecoin, the crypto will be overvalued, right? The reserves will be overvalued to secure you against market fluctuation, the volatility of the crypto space. So let's say if you're trying to buy $100 worth of crypto to a stablecoin and you want it backed by crypto, it will usually charge you an extra 50%. So it might charge you $150 for the crypto to back that $100 stablecoin. So that way, when you go to try to spin the stablecoin or anything, the fluctuation will usually cover you. The day-to-day volatility of the market, that extra $50 that you spent to back, to peg that stablecoin to that crypto, that extra 50% will cover you for the volatility for the most part. But it doesn't always work because crypto can drop more than 50% and then you kind of upside down. Crypto-backed stablecoins use smart contracts to manage minting and burning. This makes the process more reliable as users can independently audit the contracts. However, some crypto-backed stablecoins are run by decentralized autonomous organizations, DAOs, where the community can vote for changes in the project. In this case, you can get involved or trust the DOA to make the best decisions for you. Decentralized autonomous organizations. Let's look at an example. To mint 100 DAI, right, which is a stable coin. To mint 100 DAI pegged to the US dollar, you will need to provide $150 of crypto, 1.5 times the collateral. That's just what I was explaining. Once you have your DAI, you can use it however you want. You can transfer it, you can invest it, or you can simply keep it just as is. If you want your collateral back, though, you'll need to pay back the 100 DAI. However, if your collateral drops below a certain collateral ratio or the loan's value, it will be liquidated. So you lose. You lose whatever the market fluctuation of volatility. If you lost, you're going to lose what you lost if you try to convert it back. When the stable coin is below $1, incentives are created for the holders to return this stable coin for the collateral. This decreases the supply of the coin, causing the price to rise back to $1. When it's above $1, users are incentivized to create the token, increasing the supply and lowering the price. So when the stablecoin price drops below $1, they release incentives. They push out other options and other things to incentivize you to return the stablecoin for the collateral to keep it from crashing. And this decreases the supply of the coin, causing the price to rise back up. But when it's above $1, you're incentivized to create the token, to create more, increasing the supply and lowering the price. DAI is just one example, but all crypto-backed stablecoins rely on a mix of game theory and on-chain algorithms to incentivize price stability. You'll be learning what game theory is in another coming up lesson on Crypto Price Alerting YouTube channel. The last stablecoin, and the most ridiculous in my opinion, is algorithmic stablecoins. Algorithmic stablecoins take a different approach by removing the need for reserves. Instead, algorithms and smart contracts manage the supply of the tokens that are issued. This model is much rarer than crypto or cash-backed, fiat-backed stablecoins, and it's more challenging to run successfully. It's actually ridiculous. So guys, kind of stay away from these algorithmic stablecoins. Your best bet is to stay with fiat-backed stablecoins. You can gamble with the crypto-backed ones because they over-leverage, but the algorithmic ones is more than likely a nightmare in the making. Essentially, an algorithmic stablecoin system will reduce the token supply if the price falls below the fiat currency that it tracks. This could be done via locked staking, burning, or buybacks. If the price surpasses the value of the fiat currency, new tokens enter into circulation to reduce the stablecoin's value. It's like the incentive and the disincentive price, but this is actually locked into the coin itself. It goes by the algorithm. So, guys, what exactly are the advantages of stablecoins? Stablecoins are versatile, and they're actually very powerful tools for investors, traders, and cryptocurrency users. Their main strengths include: one, stablecoins can be used for actual day-to-day payments. So you can use it because the stability of the currency that's back behind it. You can use it to do your everyday life functions, and you don't have to convert the cryptocurrency back to cash. You can actually use it and know that it's actually going to keep its value for the most part. Number two, stablecoins have the benefits of being blockchain-based. Stablecoins have the benefits of being blockchain-based. You can send a stablecoin to anyone globally around the world who has a compatible crypto wallet. And I'm going to be showing you how to create that on cryptopricealerting.com. It's very easy. You can create it really quickly. Double spending and false transactions are almost impossible to run into when you're using stablecoins. These qualities make stablecoins incredibly versatile. Very, 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 very smart to purchase stablecoins. Stablecoins can be used. Number three, stablecoins can be used by traders and investors to hedge their portfolios. Allocating a certain percentage of a portfolio to stablecoins is an effective way to reduce your overall risk. Your portfolio as a whole will be more resistant to market price swings, and you will also have funds on hand in case you run into a good opportunity. You can also sell crypto for stablecoins during a market downturn, right, in a bear market, and repurchase them at a lower price. That's an example of what you will learn on our channel. Please like and subscribe. More lessons to come. Stablecoins allow you to enter and exit your positions conveniently without the need to take the money off the chain, off the blockchain. That is very, very key and important because it can be a headache trying to take your money off the chain, trying to switch ETH to Bitcoin or ETH to Doge or ETH or whatever, trying to switch it when you're trying to hurry up and make a trade before the fluctuation of the price. And then you can run into a time thing where then by the time you do convert it, you done lost 15, 20, 30% that you could have made, and now the trade ain't even worth making it. But if you have a stable coin, you can just go ahead and enter your position right there with the stable coin. You don't have to leave the process. You don't have to take the money off the chain. So it's very, very smart to do, which I will be doing as well, because when the market goes into a downturn and you want to make a buy quickly, it will be much easier if you have a stable coin and you can just do it right through the stable coin right there instead of trying to go through the whole process. Anybody who knows what I'm talking about, y'all know that's a headache and a nightmare. And you could lose a lot of percentage of your gains trying to do that process. So stable coins, of course, actually have disadvantages as well. What are the disadvantages of stable coins? These, despite their potential to support widespread cryptocurrency adoption, stablecoins still have their limitations. Number one, stablecoins aren't guaranteed to maintain their peg, their glue. While some large projects have a good track record, there have also been many projects that have failed. When a stablecoin has constant issues maintaining its peg, its gluing, it can lose its value dramatically almost overnight. Number two is the lack of transparency. Not all stablecoins release full public audits, and many provide only regular attestations. Private accountants carry these out on behalf of the stablecoin issuers. Number three, fiat collateralized stablecoins are usually more centralized than other cryptocurrencies. A central entity will hold your collateral and may also be subject to external financial and governmental regulations. This gives them significant control over the actual coins. You also need to trust that the issuer actually has the reserves that they claim to have. Again, DYOR, DR. That's why you need crypto price alerting for all of your due diligence and your research. Number 4, crypto collateralized and uncollateralized coins rely heavily on their community to function. It's common to have open governance mechanism in crypto projects, meaning that the users get a say in the development and the running of each project. As such, you need to get involved or trust the developers and community to run the project responsibly. Some example of stable coins. Crypto-backed stablecoin Maker DAO. DAI is the chain. Maker DAO. MAKER-DAO. DAI is a crypto-backed stablecoin that tracks the US dollar on the Ethereum chain network. The coin is managed by the Maker DAO community that holds the governance token MKR. You can use MKR to create and vote on proposals to change the project. DAI is over-collateralized to deal with the volatility of the crypto because it's a crypto-backed stable coin. So it's over-collateralized to keep you stable for the most part. The whole process is run via smart contracts. True USD is a fiat-based stablecoin. It is independently verifiable, dollar-pegged stablecoin pegged to the US dollar. It is the first stablecoin to programmatically control minting with instant on-chain verification of the US dollar reserves held off-chain. TUSD's reserves are monitored using Chainlink. Using Chainlink proof of reserve so that holders can autonomously verify that their true USD is backed by the US dollar held in the reserves. So you actually have proof of the reserves, which is the smartest thing that you can have. Are stablecoins regulated? Now they've caught the attention of regulators. Yeah, they're being regulated now because everything is trying to be regulated now because they want to centralize all of our digital currency and make government that currency and stop actually crypto. So it's all regulated now, but stable coins is still needed in your portfolio to regulate your portfolio. I highly suggest, just a suggestion. Some countries are even experimenting with their own stable coins. As a stable coin is a type of cryptocurrency, it will likely fall under the same regulation as crypto, which is already doing. Issuing stable coins with fiat reserves may also need regulatory approval. All right, so it is very wise of you to diversify your portfolio with stable coins. It's very, very key in this crypto space. Stable coins won't get you rich like meme coins and new coins overnight. It can in a bull market, but for the most part, the volatility and speculation in the meme coin and the new coins and trending coins is where the riches are. But the stable coins are for just that, your stability. All right, guys. Another lesson from Crypto Price Alerting. Please like and subscribe. Follow us on our Patreon and our Discord. Go to cryptopricealerting.com for all the tools. All right. See you guys on the next lesson. Love the Most High, y'all. We out.